Hi there everybody and welcome back to another stock analysis video. Today we are going to be doing a company that I've actually haven't done in this channel for a while, and that is none other than PayPal. This video was actually brought up by Kino Bambino. Don't know if that's how you say your name or not, but in my Caterpillar video he said, "Excellent video, have you done one on PayPal yet? Would love to see a breakdown." I actually have done one on PayPal, but again, the last time I did it was in like December. So things have changed, the calculator has changed, so let's analyze this company based on their fundamentals and see if maybe with the current fall in the markets, we may actually be consider buying this company now. So with that said, let's get started with this analysis. We are going to come right into the calculator, guys. PayPal does not pay out a dividend, which means that their overall cash flow is going straight into themselves to reinvest back in the company and to buy back shares, to pay down debt, etc, etc, etc. Ticker symbol of PYPL, market cap of $89.9 billion, essentially $90 billion. PE, guys, of 25.68, which is actually still fairly expensive. However, with the current share price of $77.68, well, if you guys know where this price was before, you can see that even though at 25.68 PE is still expensive, this was even more expensive before. In fact, looking at the graph for PayPal on the year to date, this company is currently down, guys, 60.15%, and on the 1 year it is down 73.51%. So you can see here on the 52-week range, the high that it was at $310.16, and as we just saw now, it is at $77.68. So you could just imagine what the PE was when we first analyzed this company, even when it was at its peak at around the $300 mark, even though right now it is still fairly expensive. Now, they do not pay out a dividend, which, as I said, all their cash was going into themselves. However, guys, for future companies that we do analyze here on this channel, I also added a current free cash flow left in millions. Usually what I do is I usually have the amount of free cash flow left on average, right? However, I also decided looking at the average is great. However, I would also like to see how much of their free cash flow is left currently within the past year or so, once this dividend is paid out. So for future companies, we will also take a look at the amount of cash flow that they have left after the dividend is paid within the past year. Now let's take a look at some fundamentals, starting of course with the net income 5 years ago of $1.8 billion to 1 year ago of $4.2 billion. That is an increase of 132%. And honestly, when it comes to the net income, guys, this is actually looking fairly good. We see a pretty good steadily increase from 5 to 4 to 3 years ago. And then 2 years ago, ironically enough, when COVID happened, it just completely shot up from $2.5 billion to $4.2 billion. And then it still remained at around the $4 billion mark the following year. Now, obviously, this spike was because of COVID. People were doing a lot more online shopping. They were probably using PayPal more, right? So this is 100% explainable. However, will they be able to maintain this $4 billion mark or even supersede it in the next coming years? That is a question that's left up in the air, because as the economy gets worse, well, people might be buying less online overall. So that's definitely something to take into account if you are considering buying this company. Taking a look now at the free cash flow. This, guys, is the lifeblood of the company and the most important metric when it comes to profits, because cash flow is what companies use to essentially pay for everything. Pay down their debt, buy back shares, overall grow the company, issue a dividend if they were to issue a dividend, and make acquisitions. So essentially, you want the cash flow to be increasing and also to be positive as well, right? Now, when it comes to PayPal, this is actually looking fairly good, except for one little bit of a hiccup. But nonetheless, 5 years ago of $1.8 billion to 1 year ago of $5.4 billion. That's an increase of 191% on the 5 year. And this is actually an average 5-year free cash flow of $4.1 billion. Now, if we actually take a look at this free cash flow, it is fairly consistently increasing. Don't get me wrong, right? 5 years ago, 1.8. 4 years ago, 4.6, which is a huge increase. Then from 4 to 3 years ago, it did go down to $3.4 billion. But then again, in 2 years ago, it shot back up to $5 billion. So I don't necessarily know what caused this decrease in free cash flow when it came to 3 years ago? If you guys know, leave in the comment section below. But nonetheless, they still had a pretty good track record when it came to increasing their cash flow within the past 5 years. And now looking at the last profit metric, we got the revenue. 5 years ago of $13.1 billion to 1 year ago of $25.4 billion. That's an increase of 93.76%. And fairly steadily increasing revenue as well, which is again really good to see when it comes to a profit metric. Now let's move on to some balance sheet numbers. Total assets minus the total liabilities. Guys, this metric tells us whether or not the company is able to cover their liabilities with their assets. You essentially want their assets to supersede their liabilities, and of course you want this value, this difference, to be consistently increasing as well. And as you can see right here, currently there are $20.6 billion in assets minus liabilities. And to their credit as well, within the past 5 years, this number has been in the positive as well as consistently growing too, which is again really good to see. Basically saying that if a recession were to hit, they have enough assets to cover their liabilities. Average total assets around $59.6 billion, average liabilities around $41 billion, and doing this difference, we get $18.4 billion. Now guys, let's actually come over here to a new metric that I actually decided to put in just this weekend, and I've actually been thinking about this for a while, and that is the cash flow minus the liabilities. Now, usually in the past, I only had the total assets minus the total liabilities. However, this metric doesn't necessarily tell you if the company is able to pay down their liabilities with the money that they have on hand. This is just assets that they have, which they will eventually need to liquidate in order to then pay off for their liabilities, which include their debt. However, when it comes to the cash flow, this is the metric that companies use to pay down their debts in the first place. So I actually put it in a graph showing if their cash flow minus the liabilities is actually going to zero or if it's in the positive. Now, as you can see right here, when it comes to PayPal, all of these numbers are essentially in the red, meaning that their liabilities exceed their cash flow. Usually this is pretty normal, especially when it comes to companies. They usually have more liabilities than they do cash flow. Essentially, what I'm looking for here is, are they lowering their liabilities year over year? That's essentially what I'm looking for instead of decreasing it. Basically, you want these numbers to get as close to zero as possible. Now, when it comes to cash flow minus liabilities, when it comes to PayPal, so you can see they are very much going in the red every single year within the past 5 years. And this is 100% normal for tech companies, right? Because tech companies, especially startup tech companies, right? PayPal has been here for a while, but nonetheless, it is still fairly new in comparison to the mega caps, like for example, Apple or Microsoft, or even other payment processors like Visa and MasterCard. It is still fairly new compared to those guys, so it is fairly understandable as to why they keep taking on debt year over year, as we can see here by this graph. And doing the average cash flow minus the average total liabilities, they're at a negative $36.8 billion. Essentially, they cannot cover their average liabilities with their average cash flows. Now coming over to the shares outstanding, a metric that shows us whether or not the company is diluting you as the investor. And companies dilute you by essentially issuing more shares. Companies do this silently. They usually hush about it because people tend not to look at this. When in reality, this is a really important metric because it is the silent killer when it comes to investing. Now, when it comes to PayPal, you know what? I have to give them credit for this. They are buying back shares at a decent amount as well. 5 years ago of 1.2 billion shares to today of 1.16 billion shares. There's a decrease, guys, in the 5 year of 3.25%, and from the previous year to the current year, this is looking at 1 year ago at 1.168 billion to today of 1.161 billion. That is a decrease, guys, of 0.6 shares, which is again really solid. They're buying back shares, therefore by default giving you a bigger piece of the company. And lastly, looking at the cash equivalents, how much money does the company have today on cash on hand? Currently, they are at almost $5 billion with an average cash of $5.4 billion. Now let's make some assumptions. This is essentially what you guys come here to see, my projections when it comes to PayPal in the future. Low, median, high, using 3 different factors: predicted share buyback, revenue growth, and of course the required rate of return. Guys, I'm going to be doing this with you guys right now, so that way you guys can see the thought process that I usually have when it comes to giving a price tag for companies. So, starting of course with the revenue growth assumption, let's come over here to Seeking Alpha in the growth tab. As As you can see here that the revenue growth year over year is 12.91% and the revenue growth forward is 15.5%. So my job as an investor, guys, is essentially to be conservative with these numbers, to think about how much the company will grow in the future within the next 4 years. Essentially, the bigger the company is already, the harder it is for them to grow. Now, PayPal does have a lot of growth potential, but nonetheless, seeing the whole economic situation that the world is in right now, I have to take this into account. So I understand that the lowest growth number that we just saw is around 12%. I'm going to be conservative with this, guys. I'm going to go 8% for the lowest assumption, 10% for the median assumption, and 12% for the highest assumption. Now, looking at the projected share buyback, well, we just saw this over here at the shares outstanding graph, right? So within the past 5 years, they bought back 3.25 shares. Now, will they continue this into the future? I don't necessarily know, but I personally think that this will 100% continue to decrease. So I'm going to say that for the low assumption that they will buy back shares at around 1%. For the median assumption, I'm going to say 2%. And for the high assumption, let's keep it roughly the same at around 3%, right? A little bit less, but still 3%. Now, with all of these assumptions for the target share price, we get $80.31 for the low assumption, $86.74 for the median assumption, and $93.61 for the highest assumption. Now let's adjust for debt. This is why we take a look at the cash and equivalents. We take the cash, then we subtract the net debt, and then we add that to the market cap that the discounted free cash flow comes up with. And if they have more cash than debt, then this number comes up. And if they have more debt than cash, then this number comes down. As you can see, it does come up by around $2 or so. So for the low assumption, now the target share price is $82.74. For the median assumption, it is $89.20. And for the high assumption, it is $96.09. Now let's add a margin of safety on top of this target share price after debt of 5, 10, and 15%, just because you don't want to overpay for something, right? The more you pay for something today, guys, the less returns you're going to have in the future. And adding a margin of safety takes into account any recession situations that we may have as well. So adding this margin of safety, this puts me between the target share prices of $70.33 to $78.61 for the low assumption, $75.82 to $84.74 for the median assumption, and $81.68 to $91.29 for the highest assumption. Guys, the current share price is $77.68. So if you believe my assumptions over here, then this actually might be a pretty good buy pretty much overall, even with some margins of safety as well, right? Even with the median assumption, we're still fairly close to the current share price, even at the highest margins of safety of $75.82, right? So this actually might show itself as a pretty good investment opportunity as it stands. I don't necessarily know what I said in my previous video when it came to PayPal, but I can 100% assure you that I said that this was a no buy. Well, now that the company has fallen 73.5% on the 1 year, well, now it's a good buy, guys. If you go see my past video and I say it's not a good buy because it's too expensive, well, now I'm saying that now it is a good buy is because the story has changed. The valuation of the company has changed. Before it was overpriced, now it's not. So, assuming my assumptions, if you believe them, then this is an all-out buy right now. But again, none of this is financial advice. And of course, every investment is the present value of all future cash flow. That's why I have this calculator, guys, available for free. Anybody could have it. It's in my calculators video. There's a link in the description. You come up here, you go to file, you make a copy, and you have this calculator for yourself. Also, on top of that, I also have a book value calculator for companies that don't have capital expenditures, as well as a reevaluation as well for REIT companies, and a dividend tracking sheet for you guys if you're interested in tracking your dividends or just tracking your holdings on a Google spreadsheet. I am giving all of this, guys, for free. All I'm asking for in return is help me grow my channel. Thank you so much for the 672 subscribers as of making this video. Oh my God, thank you all so much. It's just been I was never thinking that I would get anywhere near 600, let alone 672. Thank you all so much. I would love to get to 1,000 subscribers by the end of the year. That would be absolutely amazing. And by the way, next week, the first week of July, I am planning on doing a live stream on Market Open pretty much every single day. So be on the lookout for that, guys. Again, free content, free calculators. All I'm asking for in return is help me grow my channel, like, subscribe, comment. That's pretty much it. Thank you all so much for the help so far. All in all, when it comes to PayPal, this is a company that honestly, at first, I'm fairly certain that when I first analyzed it, it wasn't that interesting for me because it was very, very expensive. But as it stands, guys, this is looking pretty good right now in accordance to their fundamentals and accordance to their current share price. Obviously, we do have economic headwinds ahead, but we just saw that they might actually be able to cover most of their issues in the future, since that their cash flow is also increasing as well. Now, they do have a lot of debt, guys, right? Their cash flow cannot cover their debts as per our new graph that we just inputted, but nonetheless, I honestly don't believe that PayPal will go away in the future. I think people will still continue to use PayPal even with economic headwinds. That pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech sites as well as the Let's Play channel. The link is in the description below. Also, all of these new changes that I made to the discounted free cash flow calculator will be available for you guys hopefully soon after this video is put out today. So make sure you get the new version of the calculator when this video comes out, or therefore soon after. If not when this video comes out, I will put out a community poll saying that it is now available. So with that said, peace out, and I will see you all in the next stock analysis video.